NDAs 107 Financial Instrument Disclosures. The objective of the NDAs 107 is to require entities to provide disclosures in the financial statement that enable user to evaluate. Evaluate what? Significance of financial instruments of the entity financial positions and performance. So to find that what is the position of the entity, where is they performing well, nature and extent of risk arising from financial instrument to which entity is exposed during the period and the end of the reporting period, how the entity manages those risks, what kind of risk they have, cash flow risk they have, and what owing concern risk they have, then what they may have a risk of fraud, and what they may have, they may even have a risk of losing their clients, losing their business. There may be a loss due to the economic government policies, environmental policies. So that's my kind of risk may arise that they need to disclose in their financial instrument so the intended user can understand that. So you are asking to give very information. That is also true because you are a public limited company, you are a listed company, you having such a turnover. You need to say everything to company. You can't say, I won't say this, I won't say that, and all everything you need to report to the government. The qualitative disclosure describe the management objectives, management policies, and process for managing the risk. And the quantitative disclosure provides the information about the extent to which entity is exposed to risk based on the information provided internally and into the entity's key management personnel. So based upon the internal activity, how the management is managing their risk through their objective policy and process. Together, the disclosure provide an overview of the entity's use of financial instruments and the exposure of risk they create. So there are two type of risk that from external risk and internal risk. The risk that arises through internally is been mentioned in the qualitative disclosure report. Qualitative and quantitative. There are two things. Quantitative is totally the extent risk is based on the information provided by the entity. Usually, quantitative is amount of information you get, and quality is what how this information gives the quality. That's what means. The NDAs applies to all the entities, including entities have new financial instrument. Example, manufacturer, those whose financial instrument are accounts receivables, account payables, and those they have many financial instruments. As a financial institution, most of the assets and liabilities are financial instruments. Most NDAs applies to those entities they need to disclose. Non-NDAs not need to disclose this. When the NDA is required disclosure by class of financial instrument and entity shall group of instruments into class that are appropriate to the nature of information disclosed and then takes into account that the characteristics of the financial instrument. Entity shall provide sufficient information to permit reconciliation to the line item presented in the statement of question. Entity must give sufficient information. Okay. The principle of NDA is a complaint of principles of recognizing, measuring, and presenting financial asset and financial liability in NDA is 32. Financial liability is equal to presentation and NDA is 9 is a financial instrument. Mm. NDA is 32 or NDA is 9 need to principles of that to be applied in this NDAs. Disclosure in balance sheet. The entity shall disclosed. These NDAs will be given separately. If I think so to provide everything in this, it will take such a long time. So I'm going to say it separately. Entity shall disclose information that enable user of the financial statements to evaluate the significance of financial instruments of the financial positions and performance. So in this balance sheet, you need to say what is the risk and helps to enable the user. Okay, this is the problem it may arise. through this environmental crisis, we may think that there will be some risk and we are able to cope up with it. You not need to say negatively. Going concern is not going to affect, but this is the events happening. The Indian share market is going in this trend. So we are investment companies. We are going for new opportunity, and is the risk arising to foreign wars, world wars. These things you need to disclose. No. The carrying amount of each of the following shall be disclosed either in the balance sheet or in the notes. The financial assets measured at fair value through profit and loss account. So any asset that has been revalued, fair value to be said, no, you should say financial liability, fair value through profit and loss account. You seeing the liability is 10 lakhs, but you seeing receivable only 9 lakhs. Na 1 lakh is to be bad debts. Financial asset measured at amortized cost. Sometimes asset may be overvalued, undervalued, or even financial asset may will say we have the asset of 10,000 rupees, but the depreciation, the accumulated depreciation is 9,000 rupees. The actual, you can say the value of the asset is 10,000. Now the fair value of asset is 1,000 rupees based on the amortized cost. Financial liability measured in amortized cost. Yeah, okay. You got a loan of 1 crore rupees, but you have repaid 9 lakh rupees. But you are showing the okay, 10 lakh rupees loan you got, 9 lakhs you repaid. But you can't show the liability as 10 lakhs, and you can show the asset as deposits 9 lakhs. You can't show. This is manipulation. You can't do that. Should do exactly what is to be said. You should say. Financial asset measured at fair value through other comprehensive income. Financial liability, I can say a different example. Example, you have got a deposit. You gave some money to some person. At the same time, you got money from them. So there is a liability and asset to the same person. Maybe you're recognizing in the as per the financial system, I need to receive this amount. He need to pay me this amount. But net effect, you see, the same person you have given only the same instrument that is cash. So net off, you can say this is a liability that I need to pay, or this is the asset he need to receive. If the current and previous reporting period of the entity is reclassified any financial asset, then it shall disclose. Date of reclassification, a detailed explanation of the change in the business model and the qualitative description of this effect on the entity's financial statement or date of reclassification. If any asset has been reclassified from what stock to asset, asset to stock, you need to that date you should mention. Detailed explanation for change in the business model and qualitative description of the effect of entity's financial statement. Why you are changing the asset from stock to fixed asset or any other asset or asset to closing a stock? What is the reason behind it? What is you think or how you value it? What is the valuation of the right current asset what you have reclassified? The amount reclassified into and out of each category. And if you classified something from one category to other category, you should say why and what is the amount from which category you transfer to which category. That should also be mentioned. Collateral. The entity shall disclose the carrying amount of financial asset it has pledged or collateral for a liability or contingent liability. You may get loan from bank. For a loan, you should give one collateral. You should say this amount of crores or 21 crores of loan has been got through collateral of 100 acres of land. Such a way should resemble both terms and conditions relating to that pledge. Sometimes you may say that this agreement is for this many years. Within that, we need to repay it or we need to renew it. An entity holds collateral of a financial and non-financial asset, and it is permitted to sell or repurchase the collateral in the absence of a default by the owner of the collateral. It shall disclose fair value of collateral held. Sometimes you are in the business of giving loan. Some collateral is with you. If there is any default, you going to collect that collateral and liquidate it, and you're going to realize the loan we given. So what you want to give, you should give what is the fair value of collateral, what is the price in the current market price on the closing date. The fair value of any of the collateral sold or pledged or whether the entity has obtained obligation to return it. Sometimes what you do, you have asset. And that asset you can't, you got it from a person who you owe the money, and you gave the money and give the auto collector. Now you need some money. What you can do? The same asset can be given as an replaced to someone. You get the money out. So this is a fair value. The terms and conditions associated with the use of this collateral. So defaults for a loan payable recognized at the end of the reporting period, entity shall disclose details of any default during the period of principal, interest, sinking fund, and redemption terms of the loan payable. So, if there is a loan payable, what is going to be the duration and what is the principal amount? What is the interest rate? How much interest you have paid? What is the sinking fund and redemption term? Sinking fund. And I need to come into that point. And redemption terms. Redemption terms, debentures. 20 years debentures, 5 years debentures. The preferential debentures, such as the redemption of the terms. Have loans, everything. And end of 5 years, you're going to redeem the loan. Are we going to renew the loan? The carrying amount of loan payable in default at the end of the reporting period. So, what is the carrying amount? What you going to pay in the end of the period? You should see. When there has a default is a remitter, the terms of the loan payable are renegotiated. So the default is a remitter. Default is a remitter means the what we have some default, but we have repaid it. And we have renegotiated the loan terms. So we have 3 years, we need to go to 5 years. And before the financial statements are approved for the issues. And approval of the financial statement, what is the thing that also we said? A disclosure in the statement of profit and loss account. Disclosure in the statement of profit and loss. The entity shall disclose the following items of income, expenses, gains, or losses either in the statement of profit and loss in the notes. They need to disclose in the profit and loss accounts, or in the notes they need to disclose these things. What are they going to disclose? Net gains and net loss on financial asset and financial liability measured in fair value through profit and loss account. Example, what happens? You have an asset in one value that is 10 lakhs. Now you're seeing the fair value. The asset is actually not 10 lakhs, it is 11 lakhs, 1 lakh gain. Sometimes 9 lakh, 1 lakh loss. A financial liability measured in amortized cost. A financial asset measured in amortized cost. Asset and liability amortized cost. Now, sometimes there won't be any difference, but if you're making it, that will come into this point. Investment in equity instrument designed at a fair value through other comprehensive income. This what they say is you buy a share in one company, and you holding the value of the shares in based upon what the value purchase. Now, as per the investment policy, if you see the fair value of asset has increased 20, 30 times. So now it's a responsibility to show that asset in the fair value, that is market value. On 31st March, NSE, BSE, you are seeing it has been traded at this price. You're putting that in this price. So there is a change, there is an increase in the actual cost, what you have booked, and now the fair value. There is a gain or there is a loss. You need to book that in a comprehensive income or comprehensive loss. Financial asset measured at fair value through other comprehensive income. Any other asset you have, but you are seeing the revaluation of the asset that will become a total interest revenue, total interest expenses calculated using effective interest method for financial assets that is measured at amortized cost, that is are measured at the fair value through other comprehensive income, showing that the amount separately or financial liability that is not measured in fair value through profit and loss account. So this asset been shown through this financial situation, this should be shown, but it is not shown now. You are going to show in this fair value. So difference what you're going to show is to be when we change. Are you going to say the fee income or fee expenses other than the amount including determining the effective interest rate arising from financial asset or financial liability that is not in fair value through profit and loss account. Some income and expense that would be going to arise in from this financial income fee from financial income that needs to show. Plus another fiduciary activity that result in holding or investment of asset on behalf of the individual trust and retirement benefit plans or institutions. Hmm. That we should take on. Entity shall disclose an analysis of gain or loss recognized in the statement of profit and loss arising from the recognition of financial asset. Measuring an amortized cost, showing separate gain and separate loss arising from derecognition of financial asset. The disclosure shall include the reasons for derecognizing these financial assets. Should you, what, why it is being derecognized? What is the reason? What are you going to derecognize? Sometimes you're going to recognizing the financial asset is you are going to asset this asset to be shown in fair value. Sometimes you are not going to show because there is no market value of that asset. You're going to completely not recognize that. So by saying so, there may be some cost or some loss going to arise. That should be also disclosed in this financial statements. Other disclosures, hedge accounting. Entity following the hedge accounting shall provide the information. Hedge accounting now what? I'm giving hedge fund management. You get the money from people like mutual funds. You invest in it and you get a commission out of it, get a profit out of it, give the money and profit to the people. And it is risk management strategy, how it is applied to managing risk. So there is a risk. What is the risk? You have invested something at the same time that investment should go usually always in a positive stand. If it is going in a negative stand, you need to say there is a risk. How the entity's hedge activities may affect the amount, timing, and uncertainty of future cash flow. If you are going and they are going in futures and tradings, if this loss pertains, this will erode this capital. Which we need to mention. Now, what is the timing of that also we should mention. The effect of hedge accounting has been entity's balance sheet, statement of profit and loss account, statement of change in equity. And how this amount is going to affect our equity because you may got the fund from the equity shareholders, not from the hedge funds. Not only they are like investment. Sometimes the owner may put their own fund into hedge fund. So how it is going to erode the equity? That also you need to say fair value. Entity shall disclose a fair value of a class of assets and class of liabilities in a way that permits to be compared with the carrying amount of each other class of financial assets and financial liabilities. If you are going to do a fair value, that should be consistent. So why it should be consistent? Because then only it can be comparable. So as per the consistency, accrual, going concern. As per the consistency concept, these should be comparable. This financial year, the next financial year should be comparable. Such a way you should provide some disclosure. If you are providing some disclosure this year and not the previous year, and the amount which is going to which is fair valued asset, which is not been fair value previous year, that is inconsistent, that will not be fair. Nature and extent of risk arising from financial instrument. Entity shall disclose the information that enable the user of financial statement to evaluate the nature and extent of risk arising from financial instrument to which entity is exposed to the end of the financial end of the reporting period. Yeah, usually there will be some risk. What is that risk? So we need to pay back this amount. If not, we may go for this liquidation risk or the asset to be sold. If not, we may have some constraint. So this asset, if we hold it in this books for a longer period of time, we will have to pay losses. Some kind of risk may arise. Risk is due to the money flow, money which is going to flow rather than profit. Money is not going to come into it. That is a risk. Always the money is the risk point here. For each type of risk arising from financial instrument, the entity shall disclose the exposures of risk and how they arise. So, what is the exposure of risk now? What is the loss going to arise and how they arise? Sir, this asset we have a long run. That is, we put on a short call, but it is we should actually want to put a put call. So there is a judgment problem. So due to the judgment problem, this is the loss arise. The objectivity, policy, and process of managing the risk and method used in measuring the risk. So, how did you find this risk, and what is the process and policy you use to find this risk? That is also to be disclosed. This is a qualitative disclosure. Any change in the above of the previous period. And this method of following how to policy processes have changed? How what is the view in the previous year? Is there any changes in the valuation, changing in the method that you have followed in the previous year? Is the current year a different valuation? You need to think about it. That is also been said. Quantitative disclosure. For each type of risk arising from a financial instrument, the entity shall disclose summary of quantitative data about its exposure to the risk at the end of the reporting period. For each risk, for each segment, you should say detail a summary of that. So what is that risk? From whom its risk is named? How did you find this risk? What is the risk exposure? You need to mention it. Disclosure required paragraph 36 and 42 of the standard to be extent not provided in accordance with the India and concentration of risk is not apparent from the disclosure made in accordance with the A and B. So concentration risk may not be apparent. Okay. Credit risk disclosure. Information about the entity's credit risk management practice and how they relate to recognition and measurement of expected credit losses, including this method. Assumption and information used to measure and expected credit losses. So what is this credit risk? How is going to be managed also you need to see. No, what is this credit risk? Risk that management practice how to I'm sharing you. The qualitative and quantitative information and allow the user of the financial statements to evaluate the amount in the financial statements arising from expected credit losses, including change in the amount of expected credit losses and reason for such changes. Mm. Yeah, you should give what is the credit loss, what is the amount expected to be credit loss, and the reason for such changes. Previous year, this change, current year, there is an increase. What is the reason? Everything you need to disclose. Information about the entity's credit risk exposure. That is a credit risk inherent in the entity's financial asset and commitment to extend the credits, including significant credit risk concentration. What is a credit risk? What credit risk means what? I have got a loan and able to repay it normally. That is normal, that's no risk. When there is a problem of repaying on EMI, then it became a credit risk. Liquidity risk disclosure. The matured analysis of non-derivative financial liability include issued a financial guarantee contract that shows an remaining contractual maturities. The maturity analysis of derived financial liability that mature analysis shall include the remaining contractual maturities for those derivative financial liability for which contractual maturities are essential for understanding the timing of cash flow. See paragraph B11B. Okay. Sometimes the liability is not a term loan. After 3 years, you need to pay the loan back. Until then, there is interest only. You need description how it is manages the liquidity risk inherent. Okay. Yeah. How liquidity also risk now? You get a loan, you do the business, you repay the loan around. And what about other expenses? If you pay the other expenses, the paying of the loan, you need to get another loan. Such kind of problem. Market risk disclosures and the sensitivity analysis of each type of market risk to which entity is exposed at the end of the reporting period. Sure, that's come brought into AI. There may we think that they will uh, clear all this work, showing the profit and loss equity would have been affected by changes and relevant risk of variable that is reasonable possible at the date. Method and assumption used in the preparation of sensitive analysis. What is a method or assumption used of preparing a sensitive analysis? What sensitive analysis? Na? Some problem may arise. So how you going to deal that problem? And what is the assumption you are going to do it? Example, sir, US election has came down and Trump won. So I'm the company of helping Visa, helping in Visa and the US consultant, and I helping you to see colleges and job work in US. And the question is, if that becomes the case, what will happen? Whether my business is a problem, no? That is what's it. Changes from the previous period and the method and assumption used and the reason for the changes. In your previous year, you have followed one process. Right now, you're changing the process, not accounting policy. Some kind of methods, an assumption you have changed. What if that is the change? What's the reason you have changed? That you should have disclosed it. That has been said.